Alright, let's get right into it. You've probably heard the word Forex thrown around, maybe on YouTube or some finance blog, and it sounds super complicated, right? Like something only people in fancy suits on Wall Street do. But here's the secret, it's actually pretty simple at its core. Forex is short for foreign exchange. All it means is trading one country's currency for another. If you've ever traveled from the United States to Europe, you had to exchange your US dollars for euros. When you did that, you participated in the Forex market. That's literally it. Now, where the trading part comes in is that the values of these currencies are constantly changing against each other every single second. One day, one US dollar might get you 0.90 euros. The next week, it might get you 0.92 euros. Forex traders try to make money from these tiny fluctuations. They buy a currency, hope its value goes up compared to another currency, then sell it for a profit. It's like buying a stock you think will go up. But instead of a company, you're betting on the economy of an entire country. It's the biggest financial market in the world, with trillions of dollars moving around every single day, which is just a mind-boggling amount of money. The reason so many people are drawn to Forex is because it's incredibly accessible. You don't need $1 million to start. You can get started with a relatively small amount of money, sometimes as little as $100, right from your laptop at home. You just need an internet connection and a brokerage account. This low barrier to entry is amazing, but it's also a double-edged sword. It makes it easy to jump in without knowing what you're doing, and trust me, that is the fastest way to lose your money. Let's talk about the single most important thing that separates people who make money from those who lose it all within a week. It's not a secret indicator, it's not some expensive robot. It's definitely not luck. It is having a trading strategy. A strategy is just a set of rules, that's it. It's your personal instruction manual that tells you exactly when to buy, when to sell, and when to just sit on your hands and do nothing. Without a strategy, you're not trading, you're gambling. You might win once or twice, but over time, the house always wins. Would you try to build a house without a blueprint? You just start nailing pieces of wood together randomly, and you'd end up with a pile of lumber, not a home. A trading strategy is your financial blueprint. It removes the emotion from your decisions. When you see the market moving quickly and your money is on the line, it's so easy to panic. A strategy is your logical, unemotional guide that keeps you grounded and focused on a system that has been tested. Alright, let's get into the meat and potatoes of it. The strategy we're going to use is one of the oldest and most respected concepts in trading. It's called trend following. The whole idea is captured in a simple phrase you'll hear over and over again. The trend is your friend. All this means is that markets tend to move in a general direction for a period of time, either up or down. Instead of trying to be a hero and predict the exact moment the market will turn around, our job is to simply identify the current direction of the river and float along with it. It's much easier to swim with the current than against it, right? This strategy is perfect for beginners because it's visual and intuitive. You don't need to understand complex economic theories or read dense financial reports, you just need to look at a chart and identify a pattern. Is the price generally moving from the bottom left of your screen to the top right? That's an uptrend. Is it moving from the top left to the bottom right? That's a downtrend. So, how do we actually know for sure what the trend is? Our eyes can sometimes play tricks on us, especially when prices are moving up and down wildly. We need a tool that smooths out that noise and gives us a clear picture. This is where the moving average comes in. A moving average calculates the average price of a currency pair over a specific number of periods, like the last 50 hours or 200 hours. For our strategy, we use two moving averages for a strong signal. A faster, short-term moving average and a slower, long-term moving average. When the 50 EMA is above the 200 EMA, it's a strong uptrend signal. The market has more positive short-term momentum. When the 50 EMA crosses below the 200 EMA, it's a downtrend signal. Short-term momentum turned negative. That crossing is our primary filter. Before trading, check these two lines. If the 50 EMA is above the 200 EMA, we are only, and I mean only, looking to buy. Ignore sell signals. If the 50 EMA is below the 200 EMA, we only look to sell. This rule prevents fighting the market's main momentum. Let's make it crystal clear. Open a trading chart for EUR/USD, set it to the 1-hour time frame. Okay, so our moving averages have given us the green light. The 50 EMA is above the 200 EMA. We know we're in an uptrend. Now, when do we actually click the buy button? Beginners often buy as soon as the price shoots up. This is called chasing the market. You end up buying at a temporary peak, just before the price takes a little breather. We want to be smarter. We want to buy on sale. Wait for a pullback. A pullback is a small, temporary dip against the main trend. Think of it like a wave. The tide is coming in. That's our uptrend. Individual waves crash and then pull back a little. Enter during that pullback. Prices move up, dip down, move up to a new high, dip down, and so on. We are trying to buy during the dips. Better entry price, more profit, less initial risk. Buy low, sell high. How to identify a good pullback? Use the 50 EMA. The 50 EMA acts like dynamic support. Prices often come back to touch it, then bounce higher. That's the entry signal. Let's be precise. Here's the checklist for our entry. 1. Is the 50 EMA above the 200 EMA? Yes. 2. Has the price been trading above the 50 EMA? Yes. 3. Has the price pulled back and touched or come very close to the 50 EMA line? Yes. 4. Does the price look like it's starting to bounce off that line, maybe with a candle that closes higher than it opened? Yes. If all boxes ticked, you have a high probability entry signal. You are buying a dip in a confirmed uptrend. This is, without a doubt, the most important section of this entire essay. You can find the best trend and the perfect entry, but if you don't manage your risk, you will lose money. I guarantee it. This is where we talk about your two most important safety nets, the stop loss and the take profit. These are orders you place with your broker the moment you enter a trade. They automatically close your position when the price hits a certain level. A stop loss is your emergency exit. It's an order that says, if this trade goes against me and the price drops to this specific level, close my trade immediately. I accept this small calculated loss. This is how you protect your capital. Without a stop loss, a single bad trade could wipe out your entire account. Next is the take profit. This is the fun one. A take profit order locks in profits automatically. This helps you fight greed. It's so tempting to watch a winning trade and think, maybe it'll go even higher, but often the market will reverse and your paper profits will vanish. A great rule of thumb for beginners is to set your take profit at a distance that is at least 1.5 or 2 times your stop loss distance. This is called your risk to reward ratio. Let's put it into numbers. Imagine you buy EUR USD at a price of 1.1050. You set your stop loss at 1.1020. That's a risk of 30 pips. Now, you want your potential reward to be at least 1.5 times your risk. So, you multiply your 30 pip risk by 1.5, which gives you 45 pips. You then set your take profit order at 1.1095. You will either lose 30 pips or you will gain 45 pips. By setting your potential reward higher than your potential loss, you don't even need to be right half the time to be profitable. This is how professionals trade. Okay, theory is great. Let's walk through a complete hypothetical trade start to finish so you can see how the pieces fit together. Let's stick with our EUR USD currency pair on the 1-hour chart. Pull up the chart and apply our indicators. The 50 EMA, which is blue, the 200 EMA, which is red. We take one look and see the blue line is clearly trading above the red line. Great. Step 1 is complete buy-only mode. Step 2, we wait patiently for an entry signal. Price, after a nice uptrend, starts to dip. The price bars get lower, moving back toward our blue 50 EMA. It touches the 50 EMA. This is our area of interest. We don't buy blindly the second it touches. We wait for confirmation. A candle forms that touches the 50 EMA and then closes higher than it opened. That's a bullish sign. Buyers stepping in. This is our trigger. We enter a buy at the close of that candle, say at 1.1200. The very instant we're in, before anything else, we set our safety nets. Find the very bottom of that pullback. The low was 1.1170. Set our stop loss just below that, at 1.1165. That means our risk is 35 pips. Now calculate take profit. We'll use a 2-to-1 risk to reward. 35 pips times 2 equals 70 pips. Set take profit 70 pips above entry at 1.1270. And now, we wait. The hard part is over. Decision making is done. The trade is managed by the automatic orders we placed. We don't need to nervously stare at the screen. We can go for a walk, do our work, or watch some YouTube. One outcome: the price drops and hits our stop loss for a small managed loss. The other outcome: the price rises and hits our take profit for a planned profit. In this hypothetical example, the trend continues and price moves to 1.1270. Our take profit order triggers, the trade closes automatically, and the profit is added to our account. That's the entire process. Knowing a strategy is one thing, but executing it properly means avoiding the common traps that cause 90% of new traders to fail. The first and biggest mistake is risking too much money on a single trade. A professional rule of thumb is to never risk more than 1 or 2% of your total account balance on any single trade. Another huge mistake is revenge trading. When you take a loss, step away from the computer. Take a break. Don't let one bad trade turn into 5. The third mistake is not being patient. These perfect setups don't happen every 5 minutes. Sometimes you might have to wait for hours or a whole day for a good opportunity to appear. Finally, avoid the temptation to constantly tweak your strategy. Pick one simple strategy like the one we've discussed, and stick with it for at least 50 to 100 trades on a demo account. Practice it. Open a free demo account. Demo trading equals fake money in the real market. It's like a flight simulator for traders. Quick overview, the 3-step strategy. Step 1, find the trend with the 50 and 200 EMAs. Step 2, wait for a pullback to the 50 EMA for your entry. Step 3, set your stop loss and take profit immediately. Risk 1% per trade. Use a positive risk-to-reward ratio. Run your trading like a business, not a casino. Practice these steps repeatedly. Take at least 50 demo trades. Get comfortable with the process. Build confidence before risking your own money. Trade smart, trade safe. Thank you so much for reading.